Let's take a look at how we evaluate projects with unequal lives. Now, when we compare projects, we like to compare them on a similar basis. So the easiest kind of project to compare would be the ones that last the same number of years. If you're doing internal rate of return, you also want the cost to be the same, otherwise you have to make some adjustments. But in this case, we're going to use an NPV approach, so they don't have to cost the same. But we have unequal lives here. So you'll notice the first project, Project X, costs $70,000 and returns $28,000 in the first year, $33,000 in the second year, and $38,000 in the third year. And I've calculated the NPV here to be $11,277.24. In fact, let me do one of these just to help us recall how you use the calculator to do this. And you can use the cash flow worksheet, and you can hit second clear work in order to clear the worksheet. So we put in 70,000 as negative, enter, and then the first cash flow is 28,000, enter. Frequency is 1, so we can just leave that. Second cash flow is 33,000. And the last cash flow is 38,000. And I didn't mention it, but I used a 10% cost of capital to calculate NPV on both of these. So I'm going to put in 10%. And compute NPV, and I get 11,277.24. Over here, Project Y cost 85,000, returns 35,000, 30,000, 25,000, 20,000, 15,000, and 10,000. And I calculated the NPV for this at $19,013.27. And I'm not going to do that for you, but you can verify that for yourself. So how do we compare these? These two projects live for different amounts of time. Well, if they are not mutually exclusive, that is, if you can do both of them, you should do them both. They both have a positive NPV, so they're both good projects, so you should consider doing them both. If the projects are not ongoing projects, that is, they can only be done once, then you'd like to choose Y over X because it has a higher NPV. However, if they are ongoing and they are mutually exclusive, that is, if you do X, you can't do Y, or if you do Y, you can't do X, we have to figure out a way to determine what to do with these projects, okay, or how to evaluate them. What's the better project? Clearly, Y gives us a higher NPV, but after this project is done, are we just going to sit around and do nothing? No, we're probably going to reinvest in this project. Okay, it's an ongoing project. We can keep doing it. So one way to do a comparison is to annualize the NPV. And here's how we do it. All right, I'm going to use the time value of money worksheet, and so make sure I clear that, second clear TVM. This project lasts for 3 years, so I'm going to put in n equals 3. I'm going to put in the interest rate of 10%. I'll use the same cost of capital. And the present value, or the net present value of this, is 11,277.24. And then I'm going to get this to be distributed over these 3 years by computing the payment, okay, or computing the annuity. So the annualized NPV in this case is $4,534.74. Let's do the same for Project Y. Again, let's clear our workspace. Okay, this time we're spreading it out over 6 years. So n is 6, the cost of capital is the same, 10%, and we're going to spread that 19,000 $0.013 and 27 cents, and we compute the payment, and we get $4,365 and 59 cents. So we can see that while the NPV of X is smaller than the NPV of Y, the annualized NPV of X is greater than the annualized NPV of Y. So what does that mean? That means that what we could do if after this project expires, okay, or ends in 3 years, we just replicated an identical project, okay, spend another $70,000 with cash flows of $28,000, $33,000, and $38,000 one more time, we would have a higher NPV than if we purchased this project alone. And so you'll actually be better off doing 2 of these in a row than you will just doing 1 of these. So again, if they are ongoing projects, you can keep doing them. You can keep replicating them. X is a better project than Y. And again, the way to do that is calculate the NPV for each project and then annualize it. Okay, that is, find the annuity that makes that's equal to this NPV over the life of the project. In this case, 3 years. And you can see that this is higher than it is for Y. So X turns out to actually be the better project for the company to do.